All right, in this video, we're covering Treasury stock. Before I even get into that, I want to say we should probably talk about what Treasury stock is first. Okay, so Treasury stock, let's start with assets equal liabilities plus my equity. All right. We were saying that equity has two components, retained earnings and capital. Okay. All right. So let's talk about stock, authorized stock, and issued stock. So we have authorized stock. And authorized stock is determined by the board of directors. We could just make it up. Maybe the board of directors said we authorized the issuance of 100,000 shares. Then let's say that we issued 60,000 shares. Okay. So there's 60,000 shares in the market at the moment. And then let's say that we've issued 60,000 shares, and for whatever reason, we want to buy back 10,000 shares, right? So instead of having 60,000 shares outstanding, we only want 50,000 shares outstanding. So we are going to bring back 10,000 shares. When I bring back 10,000 shares, the shares that I've brought back, I refer to as treasury stock. All right. And treasury stock is like it is a contra equity account. And so it lowers my equity, right? So we can think of this as a negative number. And therefore, the shares outstanding are going to be 50,000 shares. It'll be the 60,000 shares that I have issued, and then it'll be 10,000 shares that I have in treasury stock. So I could think of retained earnings and capital. Those are the traditional accounts of equity that we originally talked about. And again, I can make stuff up. I have 30,000 in equity, and I could have 400,000 in capital, right? Related to the 60,000 shares I have outstanding. But when I buy back stock, I'm not going to lower my capital. Instead, I'm going to create a new T account called Treasury Stock. And let's just say I paid $1 for my shares. I would debit Treasury Stock by 10,000, right? Treasury Stock is now a third component of equity. However, it is a contra equity account. It has the effect of lowering equity. Now I think we can go back to the PowerPoint slides. So we can record the purchases and sales of treasury stock. So we can purchase treasury stock, meaning we can bring it back into the business, and then we could reissue those shares. Okay. There are all sorts of different reasons why we would want to buy back shares. One of the big ones is to avoid takeover. Okay, so if there's a lot of shares outstanding and the share price drops dramatically, I would be concerned that my competitors are going to acquire a controlling interest in my business. And if they acquire a controlling interest in my business, they could force me to do things that I don't typically do or don't want to do, right? They can cancel certain contracts with our best customers. They could put us out of business. So if my stock price lowers, and I'm concerned that somebody may acquire a controlling interest, they might just go out and buy up all the small portions of shares of my business, I can buy those shares back. And then we can reissue those shares to employees in the form of compensation, right? But the real reason why we would goes way beyond the concepts of the class, okay? So let's just talk about the accounting. Let's talk about what it looks like when we acquire treasury stock, okay? So on May 1st, CyberEarning purchased 1,000 shares of its own shares of stock in the open market, right? So we could be buying common stock. In fact, it looks like we are, okay? And so if I'm buying back common stock, and I'm paying $11.50 per share, and I'm buying 1,000 shares, I am going to use 11,500 in cash, 1,000 times 11.50 per share. And then, like we said, Treasury stock is now the third equity account. It's a new equity account, and it is a contra equity account, meaning it has the opposite effect of equity, right? So equity typically has a credit balance. Since Treasury stock lowers equity, we would treat Treasury stock as a debit in most instances. Okay? That is the acquisition of Treasury stock. And now what we're going to start talking about are instances when we sell Treasury stock. And I am going to use my own chalkboard. And what we're going to say is there's essentially three scenarios, okay? Three scenarios in which we will sell the Treasury stock. I will sell Treasury stock at cost. I will sell Treasury stock above cost. And I will sell Treasury stock for below cost. Okay? So let's look at the example the book gives us. So on May 21st, Cyber sold 100 shares of its Treasury stock for $11.50. So in the previous slide, we were saying that we purchased, I'm just going to abbreviate, we purchased Treasury stock, and I think we purchased 1,000 shares at $11.50, and therefore we have 11,500 in my Treasury stock account. Okay. But now in this slide, we're saying, hey, we're going to sell 100 of those, and the sale price is going to be $11.50. So this is the situation where we are selling at cost. And by cost, I mean the price that we paid to acquire the Treasury stock. This is the original price, $11.50. Okay, that is the original cost. So the journal entry to record the sale of Treasury stock at cost, it's just going to be the cash that we collect, and we sold 100 shares times $11.50 per share, therefore 1,150. And then I'm going to lower that Treasury stock account, right? It is just like I am issuing common shares. 1,150. Okay. What I would say is everything, I'm just going to keep a little note here. Everything goes in, out of Treasury stock at cost. Maybe one day I will learn how to spell, but not today. Oh, oh man, why did I do that? Bear with me. Do I get that back? I don't think I get that back. Oh, nice. Very good. Okay, so never mind. I was gonna try to redo this, but it's giving me so many problems. Everything goes in and out of the Treasury stock account at cost. That's all I was trying to write, but I don't know. I'm slow. Okay, so here it's going out of Treasury stock at cost. Scenario 2. Okay, scenario 2. On June 3rd, we're going to sell an additional 400 shares of its Treasury stock for $12. And so this is an instance where we're selling it for above cost. Remember, the original cost was $11.50. So the journal entry, I'm always going to start with cash Cash is just something that I understand. And so the cash is going to be $12 times 400 shares or 4,800. Then everything goes in and out of the treasury stock account at cost. So if I have my treasury stock account and it all went in at $11.50, then if I were to sell 400 shares, it's going to be 400 shares times $11.50, the original cost. If you do the math, you get 4,600. So I'm going to debit 4,600 for treasuries. Ah, man. Yeah. I'm killing myself. This is the worst ever. I am going to credit treasury stock because treasury stock is a contra asset account. And therefore, if I get rid of treasury stock, it would be a credit. And then if I'm selling for above cost, the rest goes into paid in capital in excess of the treasury stock account. The next note that I would write on my chalkboard, if I could, but I don't think I can, would be to every time that I deal with treasury stock, I am going to ignore par. Okay? I'm ignoring par when I'm buying back stock. It could be common stock with a par value of $2. Every time I'm ignoring par value. Okay? So the first rule, in and out of the treasury stock account at cost. Second rule, we never worry about par. Okay. Again, we're not worried about par. This is in excess of the cost that we paid to acquire those shares. Okay. Alternative example. The alternative example is that we will sell treasury stock for below cost. So remember again, we initially sold it for $11.50 and now we are going to sell it for $1.20, which is less than what we paid. Again, I'm always going to do cash. I'm always going to do cash. Cash is just one of those things that I feel like I understand. So if I'm selling 500 shares at $11.20 per share, then I'm going to receive 5,600 in cash. Man, everything is happening to me all at once. Now I can't draw in here. Bear with me. Maybe I can. No, I can't. That's okay. Okay, so step one, cash. Step two, I would do treasury stock. And again, it is everything in treasury stock comes in at cost, and everything that goes out at cost. And so the credit to treasury stock is going to be 500 shares times the original cost of $11.50 for 5,750. And in this instance, we're selling it at a gain, right? Actually, I apologize. We're selling it at a loss. We acquired it for $11.50 and then we're selling it for $11.20, which means we just lost 30 cents per share. Okay. And if I want to lower my equity, I would do it with a debit, and everything's going to come out of the paid in capital. Sorry. The loss is going to come out of paid in capital treasury stock. And if by chance I don't have 150 in that account, the next account it comes out of is retained earnings.